Hi, I'm Dan Pembleton, President of Excellent Capital Management. Today we have Mark Tokar, who is Lead Portfolio Manager on Excellent Select Discretionary Portfolios. And Mark, I just want to ask you a leading question here. We had the Bank of Canada rate hike this week, 25 basis points. We've got a lot of moving parts. They hiked rates with a lot of turmoil in equity markets around the world, and certainly the Russian invasion of Ukraine. Yet they went ahead anyway, as was expected. But what do you see things looking like going forward? Is their pace going to be the same as it would? Do you think the inflationary pressures of oil will make them go faster, or the brake on consumer spending that oil creates will make them go slower? How do you see this all playing out for us?
Yeah, reading the tea leaves on interest rate hikes is difficult on its own. But then when we start to juggle the balls of, war and oil prices increasing and sanctions, I think it just complicates the whole forecasting process. And so, I think to a certain extent, inflation has gone well beyond the expectation of central banks around the world, or at least the stated expectation of central banks around the world. It wasn't too long ago that we heard central banks use the word transitory in their discussions when it came to inflation. And I think at this point in time, we can see that inflation is more of a structural issue that's going to play out for years into the future until we get production back online, supply back online, reshoring of manufacturing from other regions of the world where we benefited from cheaper manufacturing, where China essentially exported deflation to the world market because of the cheaper manufacturing base there. We've got a structural, long-term, higher pricing level that central banks around the world now have to deal with. Complicating that issue is that we've got debt amounts on central balance sheets, banks that are just phenomenally high, and the indebtedness of nations around the world, industrialized nations around the world, it's the highest that we've ever seen. To the point where when we go back in history, we can actually point to cases where we've seen debt to GDP ratios of this sort indicate that there may be sovereign debt crises around the corner. Problematic here in Canada is that we have an economy that's really based on three major industries: energy, services, and materials. We don't really have a very diversified economy, and a lot of that also hinges on the real estate market here in Canada. And so the Bank of Canada is in very much a rock in a hard place. It's a catch-22. If they increase interest rates too fast, they risk really causing a deflation of the real estate bubble. Prices across the country are the highest we've seen. Affordability is at the lowest level we've ever seen for a house across the country. And many of these purchases have been made at the margin. When we take a look at mortgages, if we have a revaluation of equity of real estate prices and people go back to refinance, there could be a potential here that defaults increase as well. So I think what's happened here, especially in the context of the Ukraine war, the Russian-Ukraine war, is that Tiff Macklin, other central bankers around the world will see the increase of oil as acting in a very similar capacity as interest rates do. Because as oil increases, more of your and my discretionary earnings goes to filling up our gas tanks and away from what we would rather spend our money on, going out buying a new dishwasher or a new car, going on a trip. All of these things now become more expensive, and really the reason why most central bankers would want to increase interest rates is to curb pricing pressure. And the way that they do that, the interest rates go up, you're less inclined to go out and borrow and spend, and that lack of spending, the taking away of consumption, causes prices to fall by virtue of also slowing the economy down too. Factoring all of that, we've got Omicron that we need to build into this. And so when we looked at 2022, we thought, Omicron was a good news story in that the virulent nature was far more virulent than previous iterations of the disease, variants of the disease, and the severity of the illness was also drastically reduced as well, which causes or has the effect of enhancing immunity across the country, and then the lessening of many of these lockdowns would also occur, which would then add some stimulus back into the economy. If you can go out to restaurants and there are no limitations on capacity, people are more willing to spend. So there's a bit of a push and pull here as it relates to where interest rates are going to go. I think prior to the Ukraine war, we were of the mind that interest rates were going to go higher, that there may have been anywhere between 4 to 6 rate hikes within a year. But now I think there's some serious consideration that a war may in fact actually cause a slowing to the global economy, a potential recession. It may give central banks around the world an excuse to perhaps not be as aggressive in raising interest rates to battle inflation. Interesting.
So what I'm hearing you say is that Tim Macklin's got a pretty tough job ahead of him. He has inflation nipping at his heels or more, and but he also has a very fragile debt structure, both public and private, where he could really upset the apple cart with one wrong move. How many hikes do you think he can, I want to use the word, safely get into the system before we get close to the edge? I mean, my personal estimate, is somewhere in he can get 3, maybe 4, but after that, it may not be so easy.
I agree with you. I think if we see more than 4 into 6, then you have a greater impact on the housing market here in Canada. And so much hinges here on Canada in terms of housing. The wealth effect. Think about and of course the wealth effect being just simple appreciation of everyone's fixed assets, or even your liquid assets, by virtue of the stock market increasing, causes you to feel wealthier, and then gives you some confidence to go out and spend. Well, if we have interest rates that increase beyond the capacity for the system to withstand that, and it causes real estate to come off, a lot of folks who have purchased in the recent past, in the past year and a half, probably did so at the margin. If you're thinking of someone who's purchased a house that today is worth $1.5 million, that was 3 years ago perhaps half of that, it's not too far, and it's not too out of the question to think that if interest rates were to go up by 2% even, that we could see 20% come off of the real estate market. And then what happens when mortgages come up for renewal? And you go to the bank, and instead of showing a $1.5 million home, the asset value of that home is now 1.3. And a lot of that equity is out the door. So that's the risk. I don't envy Tiff Macklin his job, despite what he gets paid. I think it's going to be a very difficult call on his end. The other complication of being a Bank of Canada governor is that you can't necessarily depart too much from the Federal Reserve in how they've approached in how they approach monetary policy as well. And so by having too much of a disparity between policy, you cause these inequalities and disequilibriums. And that's the problem that we face globally, is disequilibrium. That's how sovereign debt issues happen. It's fine that everyone is in the same boat and the boat is taking on water. But the minute that there are differences and inequalities, that's when people move to the other side of the boat where you're above the water. And that's where capital starts moving back and forth. Those are some of the issues, I think, that we have to be cognizant of when we're building portfolios, when we're managing portfolios, the risk that debt has in the markets these days, the amount of debt that's in the market. I don't think the playbook from 2008 suffices here, where in 2008, the idea was use the monetary bazooka, pump as much liquidity into the market as possible, and then stop quantitative easing. You didn't necessarily have to go back in or do any further purchases, but just allow the debt to fall off the balance sheet. I don't know if they can do that anymore with the amount of debt that they have. It's a tough decision for Tiff Macklin.